Welcome to the deep dive. Today we're jumping straight into something really vital for, well, anyone involved in business or investment. We're talking about the cycles in the commercial real estate market. You know, how they work, how they feel.
Exactly. Those ups and downs, they can feel pretty overwhelming sometimes, can't they? Periods of growth, then slowdowns. It's natural to wonder, how do I navigate this? How do I position myself?
It really can feel like a roller coaster.
Yeah.
One minute you're optimistic, things are looking up the next, you're bracing yourself.
Yeah.
So our goal today, our mission if you like, is to make that ride a bit clearer, give you some solid insights, actionable strategies so you can handle these cycles with more confidence.
Yeah, not just survive the dips, but maybe even find opportunities in them. We're going to break down the whole cycle into four main phases, make it easier to grasp, and then importantly, look at specific things you can actually do to prepare and react.
Okay, great. So the roadmap is these four phases: recovery, expansion, hypersupply, and recession. Let's kick things off with that first one, recovery. What does that typically look like?
Right, recovery. Think of it as the market sort of finding its feet after things have been down. You'll usually see pretty high vacancy rates, lots of empty commercial space out there.
Okay.
And because of that, rents are generally low. Landlords are competing hard for tenants. I recall one source mentioning vacancy rates hitting like over 15% in some areas after the '08 recession.
Wow, 15%.
Yeah. And naturally, with all that existing empty space, you don't see much new construction starting up. Developers are understandably cautious.
Right, it's like the market's just waking up from a nap, maybe.
Yeah.
A bit slow to get going.
That's a good way to put it. Or like early spring potentials there, but it's still cool.
So things start subdued. What happens next as the economy maybe picks up some steam?
Well, that leads us right into the expansion phase. This is where things start to feel, well, expansive. The broader economy is improving, businesses are growing, hiring more people.
They need space.
Exactly. They need more office space, retail space, whatever it might be. So that increased demand starts pushing rents up. Landlords find they have a bit more pricing power. And seeing this, developers get more confident. You start seeing more cranes in the sky, new projects getting underway.
Expansion. That's the buzz, isn't it? You can really feel it. Business is good, optimism's high, like summer vibes, everything feels vibrant.
That's it. Full of possibility.
But I guess too much growth can sometimes lead to problems, which sounds like phase three. Hypersupply. How do we get there?
Well, hypersupply is basically when the market gets flooded. Just an overabundance of space. Developers, maybe fueled by the success of the expansion, just keep building, sometimes even without tenants lined up, yet speculative building, they call it.
Oh, okay. Building on spec.
Right. But demand can't always keep pace indefinitely, so eventually you have more supply than demand can absorb. One of our sources pointed out this often happens when lending gets easier too, making it simpler to fund new projects, maybe even when the real demand isn't quite there.
Right.
So this glut of space starts putting downward pressure on rents. They might flatten out or even start to tick down slightly. Landlords definitely start to feel the pressure, maybe offering more concessions to get or keep tenants.
Too much of a good thing then. Like planting way too many tomatoes in the garden. And our sources really cautioned businesses here, didn't they? Avoid those speculative moves.
Absolutely. It's a time for caution.
It feels like, okay, fall is here, the leaves are starting to drop, the big growth spurt is over.
A good analogy.
Which then, inevitably perhaps, leads into the fourth phase, recession. What defines that stage in commercial real estate terms?
Yeah, recession. Here, the overall economy is contracting significantly. Businesses might be downsizing, laying people off. Some unfortunately fail.
Which means less demand for space.
Precisely. Less demand leads to rising vacancy rates as tenants move out or shrink their footprint. And as vacancies climb and demand drops, rents tend to fall more noticeably. Property values often follow suit, heading downwards too.
It's the winter's chill, settling over everything.
Yeah, impacting businesses, impacting the real estate market. It's important to remember, though, as you said, the severity can vary. Different recessions hit different sectors differently.
And it's so crucial to remember what the sources kept emphasizing. This is cyclical. It's natural.
Exactly. Winter ends, spring comes again. Recessions don't last forever either.
To make this less abstract, we found a really good real-world example. The story of Jake, the fitness studio owner. Can you walk us through that?
Sure. Jake's story really illustrates how these cycles hit actual businesses. So back in 2019, things were booming, clear expansion phase. His fitness studio was doing great.
Riding the wave.
Totally. So he decided to expand, leased new, bigger spaces. Seemed like the right move to capture that growth. But rents were high then, reflecting that strong market demand. He locked himself into these leases.
Okay, committed during the peak.
Exactly. Then 2020 hit. The recession arrived, driven by, well, unique circumstances that year. Gym memberships suddenly dropped off a cliff for him. Economic uncertainty, restrictions, all that.
Oh boy.
But he was still stuck with those expensive leases he'd signed during the good times. Fixed costs, but falling revenue.
Ouch. That really drives home the importance of timing, doesn't it? Expanding right at the peak.
Absolutely critical. And it also shows why having some flexibility in leases, if you can possibly negotiate it, is so valuable. His experience is a tough reminder. A growth strategy and an expansion can become a huge liability in a downturn if you're locked in tight.
So knowing these cycles happen, seeing how they impact people like Jake, the big question is, how do we prepare? How can business owners, investors get ready for the inevitable downturns? Our sources had a lot of ideas. Where do we start?
Well, the absolute foundation, something Source 3 really stressed, is just knowing the cycle, paying attention. You need to actively monitor the key signs in your specific market. What are vacancy rates doing? Are rents going up, down, staying flat? How much new construction is happening?
Right, local knowledge is key.
Definitely. Source 5 also hit on that cycles aren't perfectly synchronized everywhere. Knowing your local phase helps you anticipate what might be coming next and adjust.
Okay, so step one, keep your finger on the pulse of your local market. Watch those indicators. Another thing that came up again and again was cash reserves. Building that cushion. Why is that so critical?
Well, it's huge. Cash reserves are your lifeline during those lean times, which, let's face it, happen in recessions. Sources 1 and 5 were really clear on this. Having that savings buffer means you can keep paying the bills, keep operating, even if revenue dips significantly.
It buys you time.
And flexibility. It puts you in a stronger position maybe to negotiate with landlords or lenders. Plus, sometimes opportunities pop up when others are struggling. Having cash lets you potentially capitalize. Source 1 actually noted businesses with good reserves were way less likely to default during the last big downturn.
Makes total sense, like a business emergency fund.
Okay, so beyond cash, what about the actual properties? What should people focus on, especially if they think a downturn might be coming?
Source 1 really advised focusing on strong fundamentals. That means looking for properties with stable tenants. Think creditworthy businesses locked into longer leases.
Less likely to default or move out suddenly.
Exactly. They provide more reliable cash flow, even when the economy's shaky. And Source 2 brought up investing in more resilient types of property, like grocery store-anchored retail centers.
Ah, necessity retail.
Right. People still need groceries, basic goods, regardless of the economic climate. Those tend to hold up better across cycles.
So prioritize stability, maybe those recession-resistant sectors. What about diversification? We hear that a lot in investing generally. Does it apply here?
Oh, definitely. Diversification is a smart play in commercial real estate, too. Source 4 mentioned this specifically. Don't put all your eggs in one basket. Spread investments across different property types, maybe some retail, some office, some industrial.
And different locations, too.
Yes, and different geographic areas. If one sector, say office, gets hit hard in one city, your industrial properties elsewhere might be doing just fine. It smooths out the ride.
Okay, smart risk management. Avoid being overly concentrated. What else can businesses do proactively, maybe even during the good times, the expansion phase? Well, discipline is key during those peaks. Several sources warned against getting caught up in the hype and overpaying. Source 3 was clear on that. When the market's hot, values get inflated. You risk buying high and then seeing values drop when things cool off.
Resisting the urge to chase the market upwards.
Exactly. And also, use those good times, as Source 3 suggested, to lock in longer-term leases with your own tenants. Secure that stable occupancy and cash flow while you can. It builds resilience for later.
Good point. Build the foundation when the sun is shining. And Jake's story really highlighted leases. What's the advice there regarding managing those agreements?
Yeah, Source 3 again emphasized being ready to talk, to communicate with tenants if they hit trouble during downturns. Sometimes keeping a good tenant, even if you have to negotiate terms a bit, like a temporary rent reduction, is better financially than having a long vacancy.
Right, vacancy costs money too.
For sure. Building good relationships with tenants helps foster that willingness to work together. Source 5 also mentioned exploring flexible lease structures, though that can be tough to get when demand is high.
Makes sense. Collaboration helps everyone navigate. What about the finance side, beyond just cash reserves? Debt lenders.
Source 5 highlighted keeping lines of communication open with your lenders. Strong relationships there can be invaluable. Maybe exploring creative financing options if needed. Knowing your terms, having that relationship gives you more flexibility. And, as they also noted, just consistently focusing on keeping cash flow healthy and vacancies low makes you a much better bet in the eyes of lenders anyway.
So nurture those banking relationships. They're key partners.
Yeah.
One last area, technology. Can tech help navigate these cycles?
Yes, increasingly so. Source 4 pointed this out. Leveraging data analytics is becoming really important. There are tools now that help you track all those indicators we talked about: vacancies, rents, absorption rates, even demographic shifts in great detail.
So you get a clearer picture faster.
Exactly. Using that data gives you more informed insights into where the cycle is heading in your specific market, allowing for more strategic decisions. It's a real advantage.
Okay, so staying informed, being proactive, or market awareness, financial management, tenant relations, tech.
Mm.
That's a lot. But we also need to talk about the emotional side of this, right?
Yep.
Because these cycles can really play with your head.
Oh, absolutely. The emotional component is powerful, and it can really influence decisions, sometimes not for the better. Think about the expansion phase. There's often that huge fear of missing out FOMO.
Right. Everyone else seems to be making deals, making money,
Exactly. And the pressure to jump in, follow the crowd, can be intense. Sometimes people dive in without really doing their homework just because everyone else is.
which can lead straight into that hypersupply problem if everyone's chasing the same thing without considering the actual underlying demand.
Precisely. And then, flip side, when the market cools down or goes into recession, what happens emotionally?
Panic.
Often, yeah, panic can set in, values start dropping, vacancies rise, and the gut reaction might be sell, get out now. Even if it means taking a loss, fear takes over.
Driven by the fear of things getting even worse.
Right. But, as the sources kind of hint, those downturns, those periods of fear, can actually be where the opportunities lie for those who are prepared. Those who've done their research, kept their finances solid, and can take a longer view. Distressed assets might become available at good prices.
So the real challenge is managing those emotions. Resisting the FOMO during the boom, resisting the panic during the bust.
That's really the crux of it, relying on your strategy, your data, your understanding of the cycle, rather than getting swept away by the prevailing sentiment.
A cool head prevails.
Pretty much. Having that solid plan, understanding the dynamics, it helps keep you grounded and stops you making impulsive moves you might regret later.
Okay, so as we wrap up this deep dive, let's quickly hit those key takeaways again. What are the absolute essentials for listeners to remember?
Okay, key things. First, just accept that these cycles, recovery, expansion, hypersupply, recession, they are the nature of the beast in commercial real estate. They happen. They're somewhat predictable.
Know the pattern.
Second, build cash reserves. Seriously, that financial cushion is vital for weathering storms and maybe even grabbing opportunities.
Got it. Cash is king.
Third, diversify. Don't put everything into one property type or one location. Spread the risk.
Makes sense. Don't overconcentrate.
And finally, maybe the hardest one. Try really hard to keep emotion out of it. Avoid the FOMO, avoid the panic. Stick to your plan, stick to the data, think long term.
So understand the cycle, have cash, diversify, and stay rational.
That's a pretty good summary.
Right. These market cycles, they're not necessarily something to dread. They're something to understand, anticipate, and prepare for.
Exactly. They bring challenges, for sure, but also potential opportunities if you're ready.
Mhm.
Understanding the patterns, using these strategies we talked about, it really can improve your ability to navigate the downturns and, ideally, position yourself well for the eventual upturns. It's about being informed, prepared, and keeping that long-term perspective.
Absolutely. So as you think about your own situation, your own properties or investments, here's a final question to mull over. How can you, right now, proactively assess the current phase of the commercial real estate market in your specific town or region? What local signs should you be tracking closely to guide your next steps? Definitely something worth digging into. Thanks for joining us for this deep dive.